Legal disclaimer. Before we begin, please remember this video is for educational purposes only. It is not financial, tax, or investment advice. Everyone's financial situation is different, so consider speaking with a qualified professional before making decisions. What is a TFSA? What is a TFSA? Advantages, features, and what not to do. If you live in Canada and want to build long-term passive income, the TFSA might be one of the most powerful tools available to you. But many people misunderstand how it works, and that can cost them thousands over time. Let's break it down simply. The problem. When most people hear tax-free savings account, they think of a regular savings account at the bank. They deposit cash, they earn a small interest rate, and that's it. But inflation slowly reduces purchasing power. Taxes reduce investment returns. And over decades, that combination can dramatically slow down wealth building. In a regular taxable account, interest is taxed, dividends can be taxed, capital gains are taxed when you sell. Over 20 or 30 years, that tax drag compounds. The TFSA exists to reduce that drag legally, but only if you understand how to use it properly. What is a TFSA? TFSA stands for Tax-Free Savings Account. It was introduced by the Canadian government in 2009. Here's the simple explanation. You contribute money that has already been taxed. Once it's inside the TFSA, all growth is tax-free. Withdrawals are also tax-free. That means no tax on dividends, no tax on capital gains, no tax when withdrawing. It is not just a savings account. It is a tax shelter. Think of it like a container. The container itself doesn't grow. What you put inside determines the growth. Inside a TFSA, you can hold stocks, ETFs, bonds, GICS, mutual funds, cash. Each year, you receive new contribution room if you are over 18 and a Canadian resident. If you withdraw money, you regain that contribution room the following year. This flexibility makes it very powerful. Let's compare the TFSA with another common account, the RRSP TFSA. Contributions are not tax deductible. Growth is tax-free. Withdrawals are tax-free. Withdraw anytime. RRSP. Contributions reduce your taxable income. Growth is tax-deferred. Withdrawals are taxed as income. Best used for retirement planning. Neither is better in all situations. They serve different purposes. Let's look at practical examples. Example 1. Dividend investing. You invest $25,000 in a diversified ETF inside your TFSA. It pays a 5% yield. That's $1,250 per year in income. Inside a taxable account, part of that income may be taxed depending on the type. Inside a TFSA, you keep the full amount. Over 20 years, reinvesting that income can significantly increase compounding. Example 2. Growth investing. You invest $15,000 in a broad index ETF. After 25 years, it grows to $90,000. In a taxable account, you would pay capital gains tax when selling. Inside a TFSA, you withdraw the full $90,000 tax-free. That difference can be meaningful over long-time horizons. Example 3. Retirement flexibility. Suppose your TFSA grows to $400,000. At a 4% withdrawal rate, that provides $16,000 per year. Tax-free. And importantly, TFSA withdrawals generally do not affect income-tested government benefits. That makes it useful for retirement planning. Key mistakes to avoid. Now let's talk about what not to do. Mistake 1. Over-contributing. Each person has a specific contribution limit. If you exceed it, you may face a penalty tax of 1% per month on the excess amount. Always track your available room carefully. Mistake 2. Day trading. The TFSA is designed for investing, not running a trading business. If trading activity appears businesslike, the gains could become taxable. Long-term investing is generally safer. Mistake 3. Leaving it in cash for years. While a TFSA can hold cash, long-term growth typically comes from investing. If inflation averages 2 to 3% and your cash earns less, your purchasing power may decline. For long-term passive income goals, investments usually provide more growth potential. Mistake 4. Withdrawing and recontributing. Too soon. If you withdraw money, you do not regain that contribution room until January 1st of the following year. Putting it back too early could trigger penalties. Mistake 5. Taking extreme risks. If you lose money in a TFSA, that contribution room is permanently lost. For example, if you contribute $20,000 and it drops to $5,000, you cannot reclaim the lost $15,000 of room. Because of this, many investors prefer to hold diversified, long-term assets inside their TFSA. So to summarize, let's keep it simple. A TFSA is a tax-free investment account available to Canadian residents. You contribute after-tax dollars. Your investments grow tax-free. It works best when you invest consistently. You focus on long-term compounding. You respect contribution limits. You avoid speculation. For passive income and long-term investing, the TFSA can be one of the most efficient tools available. Calm, disciplined, patient. Used properly, it becomes a foundation for financial stability and flexibility over time.